While silver may be currently out of favor, there's an exciting twist to its story that we can't overlook. The U.S. debt ceiling talks seem to be reaching a long-awaited agreement, which has reduced the demand for safe haven assets like silver. Consequently, the price of this precious metal has experienced a significant slide. But here's the catch. Many experts believe that this price drop doesn't align with the underlying fundamentals. It's truly fascinating to witness the current scenarios surrounding silver. Despite its recent dip, there's a crucial question lingering in the minds of investors. Will the support around $23 an ounce prove strong enough to halt silver's $3 slide since its peak above $26 earlier this month? The answer to this question holds the key to understanding the future of silver. Will it bounce back and defy market expectations? Or is this downward trend set to continue? Join us as we delve deep into the analysis and explore the potential implications for investors. So, without further ado, let's dive into the fascinating world of silver and explore the significance of the $23 support level. This is a YouTube episode you won't want to miss. Certainly, there are enough reasons to have a constructive view on silver, with the metal a key component in the energy transition, and therefore as part of the U.S. President Joe Biden's Inflation Reduction Act that is forming part of the country's debt talks. Also, with the Federal Reserve close to or potentially already at the end of its interest rate hiking cycle, then the biggest headwind for silver in the last year or so has been becalmed. So while silver may be lacking in short-term popularity, the longer-term appeal is certainly there, and should stop the price from sliding any further. What can stop silver price from sliding further? First, the government agency Federal Deposit Insurance Corporation, FDIC, announced that it would take over the failed First Republic Bank and sell it to J.P. Morgan. The second event was the disclosure by Treasury Secretary Janet Yellen that the Treasury would be out of cash and would be unable to pay government obligations as soon as June 1st if the debt ceiling is raised. With respect to the First Republic deal, the phrase, "J.P. Morgan will acquire," is deceptive. Drilling down into the finer details of the deal, it would be more appropriate to refer to the transaction as a deal in which the FDIC will give J.P. Morgan a 5-year, $50 billion subsidized loan to assume FRC's deposits, $30 billion in securities, and $178 billion in loans. Based on the latest FRC balance sheet, the failed bank has $18 billion of book equity. In exchange, J.P. Morgan will use that loan to pay the FDIC $10.6 billion and repay the $25 billion put up by other large banks. J.P. Morgan is thus receiving a $14.4 billion subsidized loan to acquire $18 billion in book equity. In addition, the FDIC will provide 80% loss coverage on all of FRC's single-family mortgages and commercial real estate loans, the sum of which represents 77% of FRC's loan portfolio. At the same time, J.P. Morgan will keep all of the debt service payments on those loans. J.P. Morgan could be seen as getting the use of free money to take on cheap capital in the form of deposits, and $133 billion of largely risk-free mortgages that generated the majority of FRC's $923 million in net interest income in 2022. This is why J.P. Morgan announced that the deal is $500 million accretive to net income, has a 20% plus IRR, and will enable a $2.6 billion post-tax profit that will be recognized immediately, with $2 billion in restructuring costs to be recognized over time. JPM stock jumped 2.1% on a day when the rest of the stock market sold off. This situation has a strong impact on the prices of gold and silver. It can be seen as a government-supported rescue of large depositors and a transfer of wealth from the FDIC to J.P. Morgan. During times of economic growth, the FDIC is able to fund itself, but in times of banking crisis, like in 1990 and 2008, it requires taxpayer funding. The government's intervention in bailing out depositors connected to Silicon Valley Bank and Signature Bank can be considered as a form of quantitative easing QE bailouts. The Federal Reserve's balance increased by $400 billion after the problems with SEB and Signature Bank. While it is starting to decrease again, both the Fed and the Treasury have indicated their willingness to provide liquidity to address any major bank issues. These deals, even though they are not direct bank bailouts, but rather depositor bailouts, create additional moral hazard. Depositors should view their demand deposits and CDs as loans with a risk of default. Bailing out depositors removes the important aspect of accountability from the financial system. In this sense, these bailouts decrease the value of the US dollar, leading to inflation and being highly beneficial for gold and silver. The Treasury's debt ceiling challenge. Regarding Janet Yellen's announcement about the potential Treasury default by early June, it is evident that Congress will negotiate a deal to raise the Treasury debt limit. Yellen's disclosure highlights excessive government spending and lower than expected tax revenues. The weak state of the economy also contributes to lower tax revenues. If a debt ceiling deal is not reached, the U.S. markets will experience a collapse. One of the main sources of Treasury financing comes from foreign capital. If a debt ceiling deal is not reached, these foreign investors will demand higher interest rates. To attract foreign capital for the substantial new Treasury issuance, higher interest rates will be necessary. However, the government cannot afford to pay higher interest costs on an increased amount of debt. The easiest way to counteract market forces will be for the Federal Reserve to fund a significant portion of the upcoming government debt increase by printing more money. This situation is extremely positive for gold and silver. Resilience and future of gold and silver prices. Despite the efforts of Western bullion banks acting on behalf of central banks and sovereign entities to prevent gold and silver prices from indicating escalating instability in the system, the prices have remained resilient at around $2,000 for gold and $24 for silver. It is possible that new support levels are being established at these prices, which could act as a starting point for a price increase. In my opinion, the price of gold will likely surpass $2,100, and silver will reach the high $20s before the end of the third quarter this year.